Hello, I'm Michael Ruger. I am the managing partner of Greenbush Financial Group, and there's been a lot of buzz in the markets recently about inflation and the return of hyperinflation. So I just want to spend some time today kind of educating you on what inflation is, how it works, like what's happened in the past when we've had these periods of hyperinflation, how has it impacted the stock market, the bond markets, your cash. So just to kind of educate you as far as what you might see later on this year if inflation does pick up. And you're also starting to hear some buzz around a theory that the government is kind of manipulating the consumer price index, CPI, for its advantage. So I want you to understand where some of those theories are coming from and how they work, because you'll probably hear more and more about this as the year goes on. We're going to start off by talking about what inflation is. So inflation is just the rise in prices over periods of time. Now, small increases of prices are okay, and they usually don't do a lot of economic damage. But you get these periods of time in history where you get these big surges of inflation where prices of everything goes up pretty dramatically, and that can be more harmful for the economy. Because if you think about it, if I've got this mug, and this mug, let's say a year ago, was $5, and I have $5 sitting in my savings account, I could buy one mug. But let's say now, a year later, this mug costs $7, but I still only have $5 sitting in my savings account. I can no longer afford to purchase this mug. And that's what essentially slows down the economy, that if prices on everything go up by too much too quickly, then we can just afford to purchase less goods and services with those same dollars that we have sitting in our accounts. The main metric that the Federal Reserve uses to measure the rate of inflation is something called the core CPI index, and CPI stands for Consumer Price Index. So what they do is they have this sample of all these goods and services throughout the economy, and they look how much that baskets of goods and services have increased over the previous month, over the previous year, and then they determine, okay, this is the inflation rate that we're seeing in the economy. And it's the core CPI, not just the regular CPI, because they kick out energy and food, because the price of energy and food goes all over the place in really short duration, so it creates noise within the index. So they say everything but food and energy is in this basket of goods and services. So again, if I've got this mug that a year ago was, let's say, $5 and now it's $6, it went up by $1, that means the inflation rate on just this mug was 20%, which is a pretty big price jump. Because when you see this chart, which I'm about to show you, of the CPI and the core CPI index, you'll see over longer periods of time, CPI averages about 3% per year. So you usually see the 3% per year run up in general prices. But you can see periods of time, like back in the 80s, when the CPI and core CPI was growing by over 12% per year. And that's one of those hyperinflationary environments. So if you think of all the goods and services in the economy going up by over 12% per year, that can really gyrate the economy. And that's what people are concerned with now, with all the money that's being printed by the government and the shortage in the goods and services. If there's only one of these mugs and people have a lot of money, the price of this mug can actually go up very quickly. So that's one of the things we're going to be talking about today. The reason why we're talking about this now is we recently got the inflation data from April 2021 saying there was an increase in the rate of inflation a little over 4% year over year, which is a good size uptick, because the Fed's comfort range for inflation is between 2 or 3. So the reason why the markets kind of react negatively to this, they say, is inflation and price pressure going to get out of control? Is the Fed, which tries to control the amount of inflation, going to have to step in and raise interest rates? Because that's the main tool that the Fed uses to say, hey, when the economy needs oxygen, we're going to lower rates. But then when the economy starts to recover and prices start going up, that's normally where the Fed starts stepping in and increasing interest rates so it doesn't overheat like it did in the early 80s. So they do that by increasing rates, which kind of slows down lending. It kind of taps the brakes so we don't run too hot, and then there's this huge run up in prices. But it's also our thinking that you have to take the April inflation reading with a grain of salt, because think about it, year over year. So you're comparing April 2020 to April 2021, and in April 2020, we were in the heart of the COVID crisis. Like the whole global economy was shut down. So you would guess that prices are going to probably be lower because technically we had a recession during that period of time, which prices normally come down. So it's going to be interesting to watch the inflation rate as we start comparing it year over year to months later on in the summer as the global economy was coming out of the COVID crisis. Now we're going to transition over to how inflation impacts the stock market, the bond market, and any cash holdings. So we'll start with the stock market. So again, a little bit of inflation usually isn't too harmful. So prices go up by a little bit, the consumer can still afford them. Companies, when they're selling these goods and services, are actually making a little bit more profit margin because they're selling those same goods and services for a higher price. It's when the inflation gets a little bit out of control, which is what we're watching for, that like we talked about before, the consumer can't purchase as many goods and services, and also the material inflation, what it costs to build cars, what it costs to build houses. If the material costs are going up, it's also hurting the profit margins of companies. So they're selling less, they're making less, and then that can in turn hurt the stock market. Next, let's talk about the impact of inflation on the bond market, which is a little bit more treacherous for bonds. Bonds do not like inflation because if, let's say I own a 10-year treasury bond right now that gives me 1.6% interest. So bought the bond for $1,000, it paid me 1.6%, and then a year 10, I get my $1,000 back. The issue is when interest rates are going up from 1.6 and now that same 10-year treasury bond is giving someone else 1.2%, no one wants my bond at 1.6 that I'm locked into. So what happens is if I had to sell that bond in the market, I'm not getting $1,000, it's going to be something less because essentially nobody wants my bond. So essentially as interest rates go up, bond prices go the other direction. So for individuals that have bond mutual funds, sometimes they'll look and as interest rates are rising, their high quality bond fund might be down 3, 4, 5% because the value of those bonds are dropping within that portfolio. The question then becomes, what are you supposed to do if you own bonds in an inflationary environment? Usually the reaction is I shorten my duration. So the way it works with inflation is the longer the duration of the bond, let's say a 2-year bond versus a 10-year versus a 15-year bond, the longer the duration of the bond you own it for, the greater it's impacted by the rise in interest rates. So while, let's say I've got a 5-year bond versus, let's say, a 30-year bond. So if interest rates go up by 1%, that 5-year bond the value of it might decrease by 3, 4, 5%. That 30-year bond, because it's locked in for such a longer period of time, that might go down by 10 or 15%. So remember in fixed income, the longer the duration of your bond to when it matures, the greater the impact of the increase in the interest rate. So sometimes the reaction is, if I think inflation is coming, you start shortening up the duration of your bond portfolio. So if your bonds keep renewing, they keep renewing at the higher interest rate. The last asset class is cash. So when you have these hyperinflationary environments or just inflationary environments in general, people that are holding cash, it creates what we call a saver's penalty. So if you got someone who's got $1,000 in their savings account today, and they're gonna have $1,000 in that savings account a year from now, but the price of everything went up by 5 or 6%, even though there's $1,000 sitting there, it's technically worth less because it's purchasing less goods and services a year from now. So it challenges kind of savers to say, how am I going to create an investment strategy just for my cash to keep pace with the rate of inflation? There's this push and pull war going on right now within the markets that say, where is inflation going? How hot is it going to run? The one push force for hyperinflation is the government has just printed trillions and trillions of dollars, put it into the economy. We know the economy is going to be opening up later this year as the COVID dissipates and people start spending money and traveling again, which is inflationary. You have people with money, they're going to be spending it. And then there's also supply constraints because COVID took the supply chain offline, there's limited goods and services out there to purchase, which is like a picture perfect inflationary environment. But the recent jobs data that we got from April may suggest something different. So in April, they were expecting the market to add 1 million new jobs, and we only added 266,000. So we're not sure. It's a little early in this to kind of say, are people just not returning to work because the unemployment benefits are rich and they're just going to stay out of the workforce until September? Or is there something other than that that's driving this weaker employment data? But actually the weaker employment data goes against inflation, because if you think about it, people aren't working, earning more money, that's typically what drives inflation, is wage growth, people making more, being able to purchase more. If there isn't much, if the employment numbers are lower, that can actually tamper down the inflation rate over the next few months. So I think you're going to see these two forces play against each other as we head into the summer. There are two things that the market is really concerned with that we're just starting to hear more and more about. So the first one is the Fed pinned down? So it's the Fed's job to kind of keep inflation in check. And normally they would do that by raising interest rates. But the question is, given the market environment and the fact that the economy has almost become addicted to 0% interest rates, if they have to start moving interest rates up quicker than they want to, could that stifle off the economic growth that the economy is expecting later on this year? So we're just going to have to wait and see. And there's also another theory out there that we're starting to hear more about, that is the government manipulating the CPI index, meaning that they're telling us that inflation is growing at 2 to 3%, but is it really growing more at 7, 8, 9%? And why would they do that? For those that believe that the government is manipulating the CPI index, I want to explain to you how they're getting to this point. So again, they're looking at goods and services in the economy. If they say this phone 5 years ago cost $500, but now it costs $1,000, that was essentially a cost increase of 20% per year. So they're saying, hey, if you look at all the goods and services, everything's gone up on average by 7, 8%. That's what they're saying. But what the Fed has started to do differently is they used to take the same exact phone, car, whatever it is, and say, this was the price 5 years ago. Here's the same phone, car now. And this is the actual, it's a cut and dry calculation. Now what they're doing is saying, hey, this phone now is a lot better than the phone 5 years ago that I purchased. So we're not going to use the full $1,000. We're going to say it's worth $600. So they're actually starting to move goods and services out of the basket, trying to justify that somehow this good is different than the one we purchased back here. But that's not normally how consumers think. We think if we purchase a cell phone back here and we're purchasing one today, it's the same thing, and that should really be driving inflation. But now that basket is starting to change in and out, which could justify some of that lower inflation data that's coming out from the CPI. But the question is, of course, why go through all that trouble? Like, why do they care what the CPI says? So when you think about the consumer price index, when that goes up, think about the impact on Social Security. So the biggest expenses of the government are the entitlement programs. Social Security, Medicare, Medicaid. It's like 60 to 65% of the money that we spend each year. So if the CPI goes up, everyone knows that your Social Security benefit goes up and is tied to that CPI index. So that means the major expenses of the government go up year to year. And as we know, we're already spending a lot more than we take in revenue. So that just continues to add to that problem. So think about it. If like your Social Security, they say, oh, it went up by 2%, you get a little bit of a bump up. If they said CPI went up by 10%, the government would have to increase everyone's Social Security and all these other entitlements by about 10% when we're already running on slim money. And the second piece of that is there's also a theory that they're going to try and inflate their way out of the government debt, which means the US has all this debt. They essentially print money to pay back the debt, and eventually we pay down our debt that way over time. But that only works if your expenses don't increase, requiring you to go into more debt while you're trying to do this. So it's like, I just want you to know, this is where this theory comes from, saying if they're putting an artificial cap on CPI, they're trying to do this print money to repay the debt to kind of get out of these large deficits. So that theory is out there. I hope this video was helpful, helping you to better understand inflation and how it could impact the markets going forward. If you have any questions, please feel free to reach out to me at moneysmartboard.com. Thank you.